Here is the most dangerous thing happening in the XRP community right now. And it's not the price. It's this. One of the most respected voices in the entire ecosystem just stood up and told a room full of XRP holders that some of their price targets are not realistic. And half the community is nodding along like he just handed them the truth on a silver platter. The other half is calling him a traitor. And both sides, are missing the actual point of what he said. What I'm about to walk you through is not being discussed anywhere near the way it should be, because David Schwartz is not wrong. But he's also not telling you the complete picture. And when you understand exactly where his argument holds and exactly where it breaks down, you're going to look at this entire moment, the Clarity Act, the ETF inflows, the VC collapse, very differently. Stay with me. This one matters. Welcome back. I'm Plan XRP Admin. This channel exists for one reason: to cut through the noise, apply real analytical frameworks, and give you the kind of calm, data-grounded perspective that the hype channels won't touch. No cheerleading, no panic, just the structure underneath the chaos. Let's get into it. Let's start with the hard truth. David Schwartz's argument, and I want to be precise here because precision matters, is essentially this. If rational, wealthy investors genuinely believed there was even a 1% chance of XRP hitting $10,000 within the next decade, competitive market bidding would have already pushed the price well past where it is today. He threw out $20 as a rough floor that logic would imply. And here is where most people either fully agree or fully reject that, and both reactions are lazy. Here's what his argument is actually good for. It's a clean, efficient rebuttal to the idea that there are secret deals, secret, sealed, guaranteed arrangements already in place that mathematically lock in a $10,000 outcome. If that were true in any knowable sense, yes, the smart money would already be front-running it at scale. Markets are ruthless at pricing in certainty when certainty actually exists. So, on that narrow point, he's right. If $10,000 were a known outcome, a guaranteed pipe in the wall, a signed agreement sitting in a vault somewhere, the price does not stay where it is. That argument holds. But here's where it breaks down. And I want you to think about this carefully. That same logic, applied consistently, would mean no asset in history should ever have underperformed its eventual peak for any extended period. Think about that. When XRP was trading at half a cent, if the market was perfectly efficient, if all rational actors were perfectly pricing probability, it should have already been reflecting the possibility of the $3 plus peak it eventually reached. It didn't. It sat at half a cent for a long time. This is not a fringe case. Markets misprice potential constantly, especially in emerging asset classes, especially when regulatory uncertainty acts as an artificial ceiling on institutional participation. The market cannot rationally bid up the full expected value of an asset when an entire class of participants, the large institutions, the banks, the sovereign funds, are legally or reputationally prohibited from touching it. That's not a failure of market logic. That is the market operating exactly as designed under artificial constraint. And that constraint, the regulatory overhang, is the entire story right now. What David Schwartz is really saying, whether he frames it this way or not, is stop waiting for secret plans. The thesis has to be built on real utility, real adoption, and real structural integration into the global financial system. And on that point, 100% agree. That has always been the only thesis worth holding. The question isn't whether there's a guaranteed plan. The question is, what happens to the price when the artificial ceiling finally comes off? Let's do the math that the impatient crowd keeps skipping. The global cross-border payments market moves approximately $150 trillion annually. The daily Forex market turns over $7.5 trillion every single day. And sitting inside the traditional correspondent banking system right now, locked, frozen, earning nothing, is an estimated $27 trillion in what are called Nostro and Vostro accounts. Pre-funded accounts that banks park all over the world just to have liquidity available when they need to settle transactions. $27 trillion. Doing nothing. earning nothing, existing solely because the current system has no better way to move value across borders quickly. Now, XRP's total supply is fixed at 100 billion tokens. Of those, roughly 55 to 57 billion are in circulation. Exchange reserves. The XRP sitting on trading platforms available for immediate market purchase have been tracking near multi-year lows according to on-chain data from CryptoQuant. Here is the supply-demand equation that doesn't get discussed calmly enough. ODL, on-demand liquidity, Ripple's flagship payment product, uses XRP as a bridge asset. The mechanics are simple. You convert fiat to XRP on one end, transmit it at near-instant speed across the XRPL, and convert back to local fiat on the other end. The XRP is in transit for 3 to 5 seconds. But here's the variable that matters for price. At higher XRP valuations, you need fewer tokens to bridge the same dollar amount, which means the network becomes more efficient, slippage decreases, and the system becomes more attractive to adopt at scale. This isn't a prediction. It's a design requirement. If even a fraction of that 27 trillion in locked nostro capital migrates toward a bridge asset model, you are talking about demand pressure on a fixed supply that the current price does not reflect, not because of secret deals, because of physics, because of the math of finite supply meeting an enormous potential utility market. Now, will that translate to $10,000 per token? That is not a number I am going to put on a date. What I will tell you is this. The math does not prohibit it. The math, under certain adoption scenarios, actually supports it. And any argument that dismisses those price targets without engaging the supply-demand mechanics underneath them is not a complete argument. It's a social media post. Now let's look at what the smart money is actually doing, because actions tell you more than price charts. Bitcoin ETFs just posted their strongest monthly inflows of 2026. Ethereum turned positive. And XRP? XRP pulled in $81 million in ETF inflows, the strongest month since December of 2025. Solana brought in $38 million. Ask yourself this. Does a firm allocating capital into XRP ETFs at that scale, through a regulated product with institutional compliance frameworks, does that firm move based on hype? Based on YouTube price targets? Absolutely not. That is calculated, legal team-approved, compliance-reviewed positioning by entities that do not gamble. And yet, at the same time, same month, same environment, crypto VC funding collapsed to $695 million, near a 2-year low. On the surface, those two facts look contradictory. They're not. What you are watching is a bifurcation in capital allocation. Venture capital is chasing AI right now. That is an undeniable fact. The GPU arms race, the frontier model competition, the energy infrastructure plays. Smart money flows to where the asymmetric risk-reward exists in the near term, and right now, that narrative belongs to AI. That capital will rotate. It always does. It rotates when roadblocks appear, when valuations get stretched, when the next undervalued asset class becomes visible. Crypto has been here before. Oil was oversold, then it caught a massive bid. Gold sat dormant for years, then it ran. The rotation happens. The question is whether you are positioned before it does. Meanwhile, Ripple itself continues to build the institutional infrastructure that makes that rotation land on XRP specifically. The conditional trust charter approval, Ripple getting approved in principle to operate as a bank, means that every condition required to finalize that charter is within Ripple's control. They are not waiting on a regulator's goodwill. They are executing a checklist. That is not the behavior of a company unsure about its future. That is the behavior of an entity building the rails that the institutions will eventually need to run on. Here is where the clock becomes real. Brad Garlinghouse said it plainly out of XRP Las Vegas. If the Digital Asset Clarity Act does not clear committee by the 3rd week of May, we are in real trouble. And he was not being dramatic. He was being precise. The window for writing the foundational rules of this industry is not permanently open. Legislative momentum is a resource. It accumulates and it drains. 3 months ago, in January, this was at the finish line. The industry hesitated. It should not have. Now we have a compromise. Not everything the crypto space wanted. The bank-like yield model, platforms paying you passive interest just for holding assets, that's off the table in this version. What you get instead is activity-based rewards, closer to a loyalty or cashback model. Is it ideal? No. Is it the deal that gets this done? Yes. Here's the brutal truth about legislation. You do not hold out for perfection when the alternative is handing your opponents the pen, the opposition to crypto, and that opposition is organized, funded, and patient. They are not waiting for you to get comfortable. They are waiting for this window to close so they can write the rules themselves in a future administration. Rules that XRP's legal clarity today does not protect against, because today's court ruling is under today's laws. New laws supersede court rulings. Get it done now. Sealed in statute. That is what unlocks the infrastructure investment from the J.P. Morgans, the BlackRocks, the Bank of Americas. Those institutions are not going to migrate their settlement rails onto a technology that might be retroactively criminalized. They need finality. The Clarity Act is finality. The fuse is lit. The question is whether it reaches the charge. Let me bring this back to where we started. Sentiment. XRP sentiment just hit a 2-year high, and the price is not moving accordingly. I know that's frustrating. I know people look at that gap and feel like they're being mocked, but understand what it actually means. The people who are bullish on XRP already have their position. The holders are holding. The believers are positioned. High sentiment among existing holders does not move the price. What moves the price is new capital entering. Capital that is currently parked in AI plays, in gold, in money markets, waiting for a rotation signal. That capital does not move on sentiment polls. It moves on clarity, on catalysts, on the moment when the risk-reward of sitting on the sideline becomes worse than deploying. Those conditions are assembling, not all at once, not on a schedule anyone can post with certainty, but the architecture is being built in real time, and when that capital does rotate in, it will not announce itself in advance. The window is not closed, but the room is getting smaller. Here is where I leave you. David Schwartz is right that secret plans are not the thesis. He is right that markets price probability, but the market cannot fully price what institutions cannot yet legally access. And that legal access is 3 weeks from either advancing or stalling out. What you hold right now is not a lottery ticket on a rumor. It is a position at the front of a transition that the global financial system is going to have to make one way or another. The math does not lie. The infrastructure is being built. The institutions are positioning, quietly, methodically, without press releases. Are you watching the noise, or are you watching the structure? Comment structure below if you made it to the end. I want to know who in this community is actually paying attention. Stay patient, stay rational. In a market fueled by emotion and noise, we thrive on data and composure. I am Plan XRP admin. The math doesn't lie, and the system is almost complete.